Hello and welcome to the Decision Day trading right here in Lagos, Nigeria. It's that time again where we decide borrowing costs. Here's what's coming up. It's Decision Day right here as Monetary Policy Committee meets for the 298th time. And top on the agenda, taming the wildcat called inflation. And it's great to have you join us. I'm Ladi Williams. And first off, let's get to some of the top stories now. But I'll give you a brief recap from the last meeting. At the previous meeting, the Central Bank of Nigeria raised its monetary policy rate by 50 basis points, bringing the benchmark interest rate to 27.25%. In addition to the MPR hike, the CBN also raised the cash reserve ratio as a CRR for commercial banks by 500 basis points to 50%, up from 45%. Merchant banks saw a smaller increase with their CRR raised by 200 basis points to 16%, up from 14%. And the consensus here is we might see another hike today. But let's get a check on what's happening with the oil market. Oil prices have edged higher today after falling in the previous session as investors they've taken stock of a potential ceasefire between Israel and Hezbollah, weighing on the oil risk premium. We see Brent crude futures rose by 15 cents to $73.16 a barrel, while U.S. WTI crude, that was at $69.09. Same trade, just like earlier this morning. Both benchmarks settled down $2 a barrel on Monday, following reports that Lebanon and Israel had agreed to terms of a deal to end the Israel-Hezbollah conflict, which triggered a crude oil sell-off. So we're seeing the bulls trying to get back into the oil market at this time, raising the Brent crude there by 0.21% and the WTI by about 0.22%. All right, and back here, we know the 60,000 barrels per day old Port Harcourt Refinery complex. That's come on stream, as a new complex is set to also come on stream by it was supposed to be mid-2024, but the group chief executive officer of Nigerian National Petroleum Company Limited, Mr. Mele Kyari, has just told the select group of journalists at the Port Harcourt Refinery that the old refinery complex has fully begun operations and has the capacity to feed about 200,000 trucks of various products per day. Mr. Kyari is alongside the authority chief executive of the Nigerian Midstream and Downstream Petroleum Regulatory Authority, Ahmed Farouk. And yeah, we're going to hear more definitely from there. We have our reporters waiting to hear more about this refinery. Definitely a big milestone here. All right, let's get a check on the metals market now. We see gold prices lost about 3% after President-elect Donald Trump picked Scott Bessent as Treasury Secretary, with reports of Israel and Hezbollah nearing a ceasefire deal, also eroding the safe haven metals appeal there. So we see spot gold, that was down about 3%. U.S. Gold futures, $2,616. Spot silver, on the flip side, that's up 0.50%. Platinum, that lost about 1.09%. Palladium, holding tight to that $1,000 level per ounce. And definitely so much to watch there in the markets with all of the issues there when it comes to tariffs. And Donald Trump has kicked off his long-feared plan for new tariffs. And we're going to find out how that's impacting markets in the UK. We have Juliana to bring us most of those details there. Juliana joins us from our London studio. Great to have you, Juliana. So we see the US dollar rose and shares dipped after Donald Trump said he'll impose additional tariffs on products coming into the US from China, Mexico, and Canada. So I'm wondering, is this sending shockwaves through the UK?
Good afternoon, Laddie. It is, and as you quite rightly said, I think there were of course fears about this, weren't there? Because we all remember during Trump's first tenure from 2017, there were tariff wars, particularly with China, but it had global ramifications, and I think this kind of protectionist America First policy, which is going to be now a part two, potentially could see the slow death of globalization. I think that's how economists this morning, or particularly in the UK, are seeing it. I think Dr. Ngozi Okonjo-Iweala, of course, who is the Director General, the newly appointed Director General of the World Trade Organization, she's going to have a lot to contend with because, yes, last night, the announcement coming out of Washington was that President-elect on day one, so January 20, we're going to see, I believe, a 25% increase on tariffs coming from Mexico and Canada. But in actual fact, Donald Trump has said during rallies that he will be imposing a 10 to 20% increase on tariffs with all America's trading partners. And now this is a major concern and a headache for the UK because, of course, for several years we've been talking about, or we've been bigging up this free trade between the UK and the US because, of course, we are their closest ally. But we know that relationships have been strained over the past couple of years, and there is going to be, or there's likely to be, an even bigger strain because we know that the Labour cabinet, the Labour government, particularly the Foreign Secretary David Lammy, have said some really awful things about Trump. So there are major concerns and there are fears. I think last week as well, Laddie, we spoke about what would happen to the UK economy if these tariffs were imposed. And according to some economists, it would wipe 1% off the UK GDP annually throughout his administration. And clearly, considering the negative numbers that we're getting out of economic data at the moment, that is not good. So yes, there are fears, but I think, away from sort of the kind of sensationalist headlines, it does spell perhaps the end of globalization. What is it going to look like? To be fair, and I know you haven't got much time, I think it is worth pointing out that some of the reasons why Donald Trump is doing this is, of course, he wants to be more nationalistic, but also I think there are some security concerns. So, for example, Canada, apparently there is a particular ingredient that is coming over the border that's used in fentanyl, which is a deadly drug, kills thousands of Americans every year, and apparently that's coming from Canada. Same with Mexico. Apparently this is about, kind of stifling illegal migration. And there are several other reasons. But the trade deficit in America, which is the difference between exports and imports, is particularly high, similar to what we have in the UK. So we import more than we export. Donald Trump is trying to change that. But by doing that, it is going to have global ramifications. So we'll see how that plays out in the coming weeks. We haven't got long until Donald Trump, president-elect, will be president.
Right, so much to expect before then. I already seen the impact on the markets so far. But there's some data out to the UK also. We see British Retail Consortium, that's BRC, is the data showing that the UK recorded the first rise in rate of shop inflation. That's the fastest or the biggest.
Right, okay, yes, and we do have UK shop inflation data. Actually, the UK shop inflation data I looked at this morning did show that shop inflation is actually going down. However, we have seen an increase in certain products, particularly tea and seafood. Seafood is becoming increasingly expensive. This is a Brexit issue more than a supply chain issue because there are just so much bureaucracy and red tape on fish and seafood items that are coming in from non-UK waters, and also tea. And tea, that's because we are having issues with supply chains. So although it is becoming a little bit cheaper, a lot of these figures, as I'm sure you're experiencing in Nigeria, even when they are positive, Laddie, it just takes such a long time to trickle down. Earlier this year, famously, the former Chancellor of the Exchequer, Jeremy Hunt, did haul supermarket bosses around the table to try and get them to stop profiteering and bring down some of those prices that they were seeing coming down at warehouse level. So that's what we hope to see in the run-up to Christmas.
Right, it's quite interesting. The prices don't come down as fast as they rise. Well, how are the markets looking in the UK?
Well, the all-share is down 0.43%. Of course, that Trump announcement after night has sent the market into jitters. The FTSE 100, the blue chip, also down by 0.43%, and the FTSE 250 is down by 0.68%. Now, no surprises that the British pound sterling was dipped against the US dollar after those announcements. It's just come up slightly since you've been on air. So the British pound is trading slightly up against the US dollar by 0.37%, although it's trading down against the euro by 0.24%, but up against the Japanese yen by 0.10%. Laddie, worth mentioning the Mexican peso and the Canadian dollar all trading down, and the Chinese yen, the Chinese yuan is also trading down, I think a 4-month low following that Trump announcement.
Right, volatility right there in the FX, the global FX market. But thank you so much, Juliana. Catch you tomorrow. All right, now let's take get a check on what's playing out in Europe. One of Europe's largest steel makers, that's ThyssenKrupp, has announced plans to slash close to 11,000 jobs by the end of the decade. This is a sign of businesses struggling, in Germany with increased competition from China, India, and Japan. But what does this mean for the thousands of employed right there in Germany? And yeah, we did talk about most of the tariff plans that Trump has for most of the countries, and I'm sure Europe is also trying to brace for what's to come with most of the tariffs that might actually go up at this point, with Trump's plan. But definitely we're already seeing that impacting most of the markets that we track, and definitely we'll see if that continues to play into trading this week. Well, let's bring in Vada now, right there with DW. Great to have you, Vada. So what's behind the job cut decision?
Thanks for having me, Laddie. ThyssenKrupp is an industrial giant here in Germany, and the announcement that 11,000 jobs are on the line really created waves here. The company said the layoffs were because of an increase in cheap imports, especially from the Asian market, which put a strain on competitiveness. But that's what the company said. However, the steelmaker has been in trouble for a while now. There were protests just a few months ago outside of the Duisburg headquarters because there was a lack of direction for the steel subsidiary. ThyssenKrupp overall is a huge company. They make a whole host of things, including escalators we use at the mall, or submarines that take scientists to the depth of the ocean. But its steel division had been causing the parent company some problems. And only a few months ago, the head of the steel division quit his job. This made workers really nervous. With management quitting, a host of internal issues, and increased global competition, these job cuts are a way of cutting costs for the company. Looking at major steel producers globally, the list is filled with companies from China, India, Japan, and South Korea.
And there's been a few announcements of layoffs in recent days in Germany. What does this say about the state of businesses in Germany?
Yes, ThyssenKrupp is only the latest to announce job cuts. Auto tech company Bosch, that also makes washing machines and electric stoves, announced that thousands of jobs will be slashed at that company as well. The list also includes Siemens and automaker Volkswagen. So this is definitely a time of extreme uncertainty for workers. And each company is using different tactics, from reducing working hours to encouraging voluntary departures. This means that workers will have to find different jobs after giving years and in some cases decades of their lives to big German businesses like these. So what we're seeing is mass layoffs, and at the same time, Germany is constantly looking for skilled workers in sectors like social work, in sectors that require them, for example, social workers, sales personnel, childcare workers, electricians, and physiotherapists. It's quite a precarious situation. ThyssenKrupp recorded a 1.5 billion euro loss for the year 2023-24 and a 2 billion euro loss the year before.
All right, last trading week of November, what do you see in the markets in Europe?
So the market is reacting to Trump's tariff announcement. Shares in Asia declined today over worries that sweeping new tariffs directed at China, Canada, and Mexico will have huge impacts on the market there. As a result, the dollar climbed and is performing much better today compared to yesterday. The pan-European Stocks 50 futures dropped 0.9%, and the euro slipped by 0.2% to the pound and 0.17% to the dollar. Investors are also keeping an eye on Lebanon, as a potential ceasefire that would halt Israeli strikes in Lebanon would be welcomed. Oil prices rebounded slightly as investors weighed how realistic this ceasefire deal would be.
All right, Vada, thank you so much for giving us the details of what's playing out right there in Europe. Thank you. All right, let's get a check on lending rates and inflation in Africa. And definitely we'll have Anete Ede to give us those details. Who's cutting and who's not? Anete.
Yes, good afternoon, Ladi, on
Great
this
to have you.
Business Incorporated special edition.
Right.
It's the monetary policy meeting of
It's all
Nigeria.
about lending rates at this point. How much is it going to cost you and I to borrow money?
As for the borrowers,
At this
and of
point.
course, this is particularly to manufacturers and other people who need to do businesses
Right.
from the banks. But of course, it's not going to be that easy.
Yeah, and
Because
I'm wondering at this point, you know, looking at Africa as a whole and the developed economies, the major economies in Africa, and I know some are already cutting rates. You know,
Yeah.
quite interesting.
Quite interesting.
That right here in Nigeria, we would love to see, you know, a rate cutting cycle, but it seems we only have two options here: a hold or a hike.
Yes, and let's not forget that sometime in the middle of the year, at an event, the central bank governor Yemi Cardoso, Dr. Yemi Cardoso, had mentioned that the likelihood of a rate cut is not too far away, but that was just about some 4.5 months ago. But I don't see that coming, because just after he made that statement, the next MPC meeting saw the interest rate rising all the way from what it was before, from 26.75% to about 27.25%. Okay, and now that today is the decision day, the announcement will be made, and of course, there's no insight into, there's no clear direction that as a matter of fact, it points to another hike. Whether a 0.25%
Is it
or
25 or
50 basis
50?
points, but it's definitely going to be a hike. I'll be surprised, just like last time. That,
Maybe we should bet, you know, at some point. And
you just can't bet, because last time we had a bet that
Right.
they were going to hold, because at some point, the inflation had dropped all the way from its peak of 19%, which was recorded in June. And then they've now picked up to about what we had just a couple of weeks ago,
all right,
33.88%.
I hope at the end of the day, when we get a decision, you might lose money to me. But let's see what's playing out in
Ladi,
Africa.
I don't do bets, I don't do wages, but
Right.
of course I do the market figures. So let's talk more about Nigeria's Monetary Policy Committee meeting, which is this is the final day and the last one for the year 2024. Of course, the next time that the MPC will be meeting will be next year in January. But that date has not been confirmed yet. But let's take a look at the board first. Nigeria's MPC meeting. Well, this is one of the reasons why the Monetary Policy Committee is hiking the interest rate, or had hiked the interest rate for about 13 times since it started that cycle in 2022. The reason is because the inflation is stubbornly rising on the Nigerian inflation environment, is still rising. At some point, it had made a 2 consecutive month pause, but it picked up from that 34.17%, which I mentioned, and climbed back to about 33.88%. And of course, we have so many projections from economists that it would get back to the 34% level due to high price of everything in the country, particularly food, energy prices, oil, fuel, or petrol. And so all that is lifting the inflation numbers to climb higher. And at the same time, we also see the lending rate, the monetary policy rate, which is the benchmark rate. We also have the asymmetric corridor as well as the cash reserve ratio and other measures by the central bank. But this is the key one to look out for: 27.25% lending rate, which was increased at the last meeting in September. So your guess is as good as mine. Whether the CBN would hike, well, we're actually expecting it to be a hike. But like I mentioned with Ladi, that we'll be surprised that the CBN would, if it would cut, because inflation for November is going to be is pointing to be higher, as well as December, due to the festive season demands. So now let's move from Nigeria to South Africa, which is the second biggest economy. Well, according to some people, that's the second biggest economy, but that's always a subject for contention. The last time they met was just last week, where the Reserve Bank cut the interest rate to 7.75%. The prime lending rate was also unchanged at 11.25%. And this is because inflation slowed all the way from 3.8% to about 2.8% in October. And then the next time, which is that they'll be meeting for a monetary policy decision, will be sometime next year, January the 30th to be precise, 2025. So far they've had their last meeting. We saw that the Reserve Bank said the falling prices of fuel were the primary drivers of the slowdown in the annual inflation, like I mentioned, down from 2.8%, down to 2.8% from 3.8% in September, as well as slowing food inflation, which was another important factor for the reason why the interest rate was reduced. And next stop is Ghana. The Bank of Ghana, they held their last meeting in September. So the next meeting will be in, actually it was yesterday, but that announcement is yet to be announced. But the lending rate was reduced at the last meeting in September to 27%. And this is because inflation, the country's inflation had slowed to about 22.1% in October. Let's not forget that Ghana's inflation had risen to as high above 50% sometime in 2022. And then that inflation number has gradually reduced, all partly because of the central bank's actions there. Falling inflation, the country has been able to tame its own inflation, and of course they still see that inflation in the country is going to continue to ease. The central bank is already seeing a 13% to 17% reduction in the inflation rate, and then steadily moving towards the medium-term target by the end of 2025. So from Ghana, we move over to Kenya, where we see another rate cut there announced by the Bank of Kenya. Lending rate was lowered to about 12%. Inflation dropped to 2.72% just last month. And then the next meeting of the Kenya Central Bank will be on December 5th, which is just next month. They're not too far away. Let's just call it like about next week. That's when the Bank of Kenya will be meeting for its monetary policy committee meeting. And of course, they're also seeing the factors that drove the decline in the monetary policy rate was a stable exchange rate, lower fuel inflation, a decline in inflation, and then a sharp deceleration in credit to the private sector. So the central bank's committee met and they considered these factors and decided to lower the rates to about 12%, which is what you see here. And of course, we'll be expecting that next meeting, whether it's going to be a cut, but of course, they're looking out for a cut for that country. And finally, we go over to Angola, where we see that at the last meeting that they had sometime almost about 2 weeks ago, that the Angola's central bank had left the lending rate unchanged at 19.5%, and this is because inflation had eased in that country to about 29.17% in October. And the next meeting for that country will be sometime next year. That date has not been announced yet, but so far the country's forex reserve stands at about $14.8 billion as at October, and that's enough to cover about 7.8 months of imports. And the Angolan kwanza has depreciated by about 9.9% against the dollar, currently trading at 910.9 against the dollar. So, Ladi, that's it for the countries that we track, major African countries that we track, where we put their economy side by side with ours.
Yeah, quite an interesting picture there. We see some countries nearing the inflation target or even going below it,
yes,
and interest rates being cut in most of those economies. But hopefully, we'll get there. At some point.
Well, Laddie, I don't want to be a sour Tom, but the thing is, when you look at Nigeria's economy, the inflation environment, we've been trying to tackle inflation, I think, right from when I was just a kid. But at this time, the inflation rate is at a 30-year high. How are you going to cut it? The central bank had said they were targeting a 21% earlier this year. But that is far from the horizon, it's far from that vision. Sorry, I'm not going to be, I'm not really a pessimist, but I'll be a realist, and I don't see that coming. Maybe,
and it was a long time ago.
Maybe the middle of next year.
And it was a long time ago that you were a child. But definitely, we hope things change at some point.
Daddy,
Thank you so much.
Don't be a chronographer.
Thank you so much, Anita. There, we're giving us the details of most of these other African economies that we track, and seeing how most of the inflation rates are already heading downward, and they're trying to get back into that that rate cutting cycle. But after the break, definitely we're going to head to the CBN office, and we'll give you visuals of what's playing out there. At some point, the central bank governor is going to tell us what the interest rate is going to be. But right here, we'll give you analysis. Do stay with us. We'll take a break right now. Policy Committee has officially kicked off its final two-day meeting of the year in Abuja, with some analysts speculating that the committee may raise interest rates by 25 to 50 basis points as the MPC evaluates key economic indicators and fine-tunes policies aimed at controlling inflation and fostering economic growth. Attention is focused on the decision, which is expected to impact borrowing costs and the broader economic landscape in the months ahead. Well, joining us to analyze, we have joined us via Zoom Professor Joseph Nana, is the Chief Economist, Development Bank of Nigeria. And also right here in the studio with me, we have Mr. Dolapo Ashiri, is the Managing Director, Interstate Securities. He's right here in the studio. And we have Professor Joseph Nana right there on Zoom. It's great to have you both on the show.
Thanks for having me.
So I'll start with you, Professor Joseph. So looking at other African economies at this time, you see Anita there painting the picture of what's playing out with the inflation rates. We're seeing inflation lowering in most of the top African economies, and they're also entering a rate-cutting cycle with cuts already, at their previous meeting. So what would you say these countries are doing differently to actually get to their inflation target and start cutting rates?
So thanks for having me, Laddie, of course. So typically, when we see the interplay between monetary and fiscal policy, you want to ensure that economic policies, that is to say, the fiscal side, as well as the monetary side, are well calibrated. Meaning that if, on the fiscal side, they're conducting a multifaceted program where a lot of liquidity is being pumped into the economy, then the monetary policy authorities, on the other hand, should now observe the productivity gains from the liquidity surge and begin to, if you like, start tapering off or reducing the amount of liquidity in circulation to ensure that there's enough monies in circulation to achieve aggregate productivity. So in other climes, you first look at what's happening in the exogenous variables. So what's happening outside of the economy. For example, if you take a look at Nigeria's trade partners, the US, the EU member countries, including Spain, of course, you have China. If you take a look at France, if you take a look at these countries largely, you will see that inflationary pressures have kind of reduced. And if that is the case for Nigeria, if our trading partners are reducing, our inflations are going down, it implies that internally within the country, our inflation should be going down if the problem was largely exogenous. In other words, outside of the model. But as we've observed now over a period of several quarters now, a lot of our problems is internal or endogenous, which implies that is a structural issue, whether it's lack of productivity, whether it's the insecurity affecting the agricultural output, whether it's the I would say lowered production output in terms of crude, and so on. So these are largely the variables that's driving productivity growth. And of course, let's not forget services. So if we know we don't have an adequate enough structural policy to support aggregate productivity in the country, then we'll struggle with a lot of liquidity, that is Naira, in circulation, and we'll be chasing illiquidity of FX, causing exchange rate issues, causing inflationary pressure. So what other climes are doing different from Nigeria is, I would have to say, a more closer knit calibration of monetary and fiscal policy. In Nigeria, for example, we are in an upward trajectory in terms of calibrating what monetary and fiscal policy should look like. As it stands today, we know agricultural production levels are low. So the GDP contribution from agriculture is probably going to come in, if my numbers serve me right, very low on a quarter-on-quarter basis, 2-3% thereabout. But if you take a look at overall as the economy, as we see it, the inflationary pressures we see are actually not driven by exogenous variables. And it's not going to be cured solely by the monetary policy authorities. And I have a gut instinct that they know this. That's why there will be a lot of meetings occurring where the fiscal authorities and monetary authorities come in the same room and start fine-tuning their programs to ensure that they're delivering better output growth and inclusive growth. Because in the end, the way I see it, even though I saw the GDP figures last night come in around 3.46%, while it's a welcome growth, dare I say, it's not inclusive because the broad swath of the country are still living in challenging times. And indication is to show you this. 2 years ago, you can take a sampling of the country. A lot of folks, especially in the rural area, were pivoting from firewood to gas cylinders for cooking. Now they reverted back because gas is too expensive. And that tells you everything you need to know.
Right. And Prof,
inclusive growth.
Yeah, at some point I was going to come to that third quarter GDP report, in the course of the show. But,
I beat the gun.
Yeah, but looking at a country like Kenya now, we saw the inflation rate actually, came down in the last report. And that was on the back of lowered energy prices. Energy prices came down there. So I'm wondering, do these countries, do they take their currencies and, critical prices of, some critical products more seriously, than we do? Because we see energy prices actually dropping in a country like Kenya, and they're not an oil producer.
Okay, that's a fair point. So if you take a look at what happened let me give you an example, a concrete example. You mentioned Kenya. Look at what happened during the COVID-19 pandemic with Russia. Russia essentially told all EU member countries, if you want gas, lower energy costs and so on, you must buy in ruble, in our local currency, which implies that you can produce enough for consumption and exportation. So the question is, does Nigeria produce enough crude, refined crude, for consumption and exportation? With the Dangote refinery that came online, we're going to test that theory out. So I think it's still early days, but I suspect if the federal government with the Dangote refinery can reach a middle point whereby they allow the marketers begin to get enough crude, refined petrol from Dangote refineries, if he can supply enough to the market and still export, then I assure you, productivity growth will be achieved. It might largely be inclusive because that filters across the economy, because that's what our mainstay is. But the reality of the day I see right now is that there's always conflicting numbers from what OPEC versus NMPC versus what the federal, everybody's giving conflicting statements of what the production output really is. On average, 1.4 million barrels per day. I've seen some reports, 1.8 million barrels per day. I don't really know what the numbers are lying, but I do know one thing. We need not just to focus on crude alone. The economy is much bigger than just crude. I know FX revenue is largely from crude, but Nigeria has way more than crude to offer. There's so much in the economy to offer, and we're not really tapping into these resources. I'll pause there.
Right. Thank you so much for that, Prof. But let me come to Mr. Dolakwa Ashiru now. It definitely is quite interesting,
yes, it is.
To see your fellow brothers, talking about other top African economies, seeing that inflation is not looking so bad. But another thing is, we've heard about situations where the data is pointing to reduction. But when you hear the citizens, when they go to the stores, the prices still feel very high. Do you think that's a situation playing out in most of these countries?
That's the situation playing out in most of these countries. When you look at African countries, the countries with the highest inflation are Nigeria, Egypt, and Ghana. And that's largely on the back of high cost of fuel, distortions in the supply chain, and also those aspects. Nigeria's case is also unique also. Ours was because of, for obvious reasons, there was distortion in our own supply chain too, and food, and also challenges with our currency. That's what has taken Nigeria's inflation to about 33.88%. And it's going to remain on the high side even till next year. Now, when it comes to our economy, our major source of, this is the disparity. Our major source of external revenue is crude oil, but the contribution of crude oil to our GDP is low. Our major contributor to our GDP is non-oil, but the value of export is low. So there's a contrast there. So for us to be able to take our GDP to where it's supposed to be, that's a bit of restructuring. Now, the growth rate in Nigeria is about 2.6%, and our GDP as of last month was about 3.46%. When your growth rate is so near your GDP, it's not a good place to be. Ordinarily, in our economy, our GDP should be multiples of our growth rate.
Because we're over 200, about 200 million.
200 plus and counting. And Nigerians really like giving birth. So we should be at least 6-7% for us to know that our economy is moving forward. So a lot of things need to be done over that. And the problem is that we have an extractive economy. So for example, until Dangote Refinery came, we export crude oil and import refined petroleum products. That doesn't work. Our major non-oil export in Nigeria is cocoa. We take raw cocoa out and we bring refined cocoa, we bring it back to Nigeria. Right. It doesn't make sense. So for agriculture and manufacturing, the agriculture to really make sense in this country, we have to look at the entire value chain and start processing. We're extractive. For example, most Nigerian graduates that finish courses like petroleum engineering, mechanical, they're all working in banks because until Dangote came, there was no viable or functional refinery. So that entire food value chain needs to be changed. Where we're no more extractive, we now refine, we now process food. Right. So that would change a lot of things for the non-oil sector. Right. What's happening us now, because of the high exchange rate, it's very lucrative for Nigerian farmers to export agricultural products. So I think we should look more at making agriculture make more sense, because as of now, the contribution of agriculture to the GDP is always less than 30%. I think we can do better. When we want to get all this look at the entire value chain and add processing, it will do far better than what it's doing now. Right.
Now, definitely, we've looked at top African economies, and you see some of them actually hitting their inflation target. But if we go out of Africa, we see the likes of the U.S. also, close to their inflation targets. Even though we saw inflation, for last month, that ticked up higher than expected. Yeah. We're seeing the same thing play out in UK. So do you think there's a risk that we're going to see rising inflation trend again for those developed economies with the way it's looking?
Yeah, it's most likely. But the issue also is this. The Trump effect. When it comes in, is baby frack. They're going to increase U.S. oil output. In a way too. Because right now, a barrel of crude oil is about $75 per barrel. If Donald Trump plans to increase U.S. oil output by 3 million barrels within the next 4 years. That could also mean that the price of crude oil could also start trending downwards in the next 1-2 years. And the fact that there's also peace there's gradually coming. Things like there's gradually peace gradually emerging in the Middle East. You can see Hezbollah and the rest saying they want to sign agreements, ceasefire, all those things. And Donald Trump is basically an anti-war president. So once there's more and more calm in the Middle East, it could tend that you start seeing, and also when America starts to do more fracking and exporting and fully tap into the oil production potential, it could mean that the price of crude oil globally will start trending downwards. That will affect our reserves. So there's a lot of dynamics there. So for next year, my outlook for next year is that our GDP will still remain below 4%.
All right, we'll definitely keep watching. But, Prof, let me take this to Professor Nana this time. So, we did get a message, from Trump earlier. He's talking about tariffs from some particular countries. So, definitely, we're already seeing that send shockwaves around the major markets today. So, is there a risk that this would be actually real, when it comes to these developed economies the inflation starting to rise again, even though we're seeing rate cuts?
Well, for the U.S., I suspect the idea behind that is for a stronger dollar, right? When you hike and the unfair trade agreements between the U.S. and its major trading partners. And Trump administration has felt for a while now that they have been at the poor end of the bargaining table. Okay, but as it relates to global growth and so on, I don't see it really affecting Nigeria per se, because it's a function really of who your major trading partners are. How much do we trade with the U.S. versus how much do we import from the U.S.? That's the export-import relationship and so on. But I do get a strong sense, though, that what happens in the interest rate environment in the U.S. will naturally affect globally. And that's right now, as we see, as it stands right now, we have a higher interest rate environment. So as a result of that, it's more attractive for foreign portfolio investors to come to Nigeria because it's attractive. But once we start cutting rates and once interest rates start tapering down, then you have a capital reversal naturally. And we'll probably begin to see that shortly. But as it stands today, President Trump is actually a very, I won't call him a controversial figure, but he knows what he wants. And it's about the man himself. The way I see President Trump, once he says he's going to do something, he will definitely follow through on it. And if he believes the U.S. has had a shorter end of the bargaining table for a while, then he's trying to go to reverse that, and which he rightly should, because every country, every president should focus inward first. So the America First mantra doesn't surprise me. I mean, if you're Nigeria, will you say America first? Of course you say Nigeria first. If you're South Africa, you say South Africa first, and so on and so forth. So, but in terms of overall growth prospects, a stronger dollar bodes well for the most part, but how long could that be sustained for? Only time will really tell.
And does it mean, if we start to see these inflation numbers tick up more, we should just kiss the rate cuts goodbye in the U.S. and most developed economies?
I'm sorry, can you repeat that one more time?
No, if inflation continues to rise in the developed economies like the U.S. and U.K., do you think this rate cutting cycle is going to be short-lived?
Of course. If inflation, the policy prescription, any central bank will tell you, if inflation inches upwards for the first month, they might hold. If it continues with other variables changing as well too, then the natural reaction to that, it would be start to change position. So for example now, inflation right now, as last reported by the NBS, inched upwards, right? GDP simultaneously grew, according to the NBS, to 3.46%. So I believe, based on that, any monetary policy authority would say, given what we know as far as liquidity concern and exchange management is concerned, the tendency of hiking is high. Hold is probably going to be low, but to cut rates now is improbable.
Right, and at this point, seeing that we've been raising rates for a while now, for quite a while, definitely, and getting over 800 basis points, and seeing that for this last GDP data for the third quarter, we're seeing growth, there. So is it telling us that we're not really sacrificing that much growth as we're trying to tame inflation? That's for the MPC.
So that's a fantastic question, Ladi, because the way I see it is, it means that there's still a lot of more room to hike rates. Because if the liquidity is still out there and we can still see GDP grow at that level, even higher than last quarter, it still tells me the monetary authorities still have elbow room to keep hiking rates. So my suspicion is we don't have a real idea of how much money is really in circulation. Because if you hike rates this much and we're still able to grow by this magnitude, it tells me that there's still a lot of more room to hike rates. And it implies that the calibration in from the monetary policy side needs to be revisited. And I say this because if you're hiking rates by this magnitude, you're adjusting CRR to 50%, the asymmetric corridor along that line too. I believe the commercial banks, merchant banks and the likes would be really screaming to the high heavens that this is too much. But yet, here we are demonstrating that even though they have done all of this monetary policy prescription, we're still able to grow at this level. So it tells me the monetary policy authorities are probably going to hike rates, but in order to get exchange rate management correct, we need to really watch how we spend on the fiscal side, because that's really where the rubber meets the road. The types of programs coming on board needs to be weighed cost benefit, because in the end, the amount of liquidity in circulation, the GDP growth should be much larger. It just should be much larger. Because if we're saying we're growing by 3.46% and we have trillions of naira in circulation, then there's something definitely wrong in terms of our aggregate productivity levels. It's very low if we're only growing by 3%. Meanwhile, we have all this money out there in circulation. So, except something is missing, I sincerely believe that the MPC today, the decision wouldn't be too difficult to make. 50 basis points should be the minimum they would consider.
All right, we'll definitely find out at some point, in the show. Well, let me come to Mr. Ashuru at this point. Seeing how many rate hikes we've had alone, this year, and, looking at the growth for Q3, and I try to imagine we didn't have most of these rate hikes. Does it mean we'll be growing at maybe 6% at this point?
Our aggregate productivity levels is still very, very low in Nigeria.
Right.
And I'm looking at anywhere between either 25 basis points or 50 basis points after the meeting, at the conclusion of today's meeting. I think they'll probably run it up at 25 or 50 basis points, but more like 25. I think this is the last MPC meeting of the year. I don't think they'll just leave everything quiet. I think they will do something. So 25 or 50, but...
And looking at, festivities, that's upon us at this point. And, even though we know some investors might be expecting some kind of Santa rally, we don't know if that's going to happen, this Christmas. But that means they're going to price all of that into this rate hike, because the next time they're meeting is in January. So what are you seeing playing out between now and January?
I'm seeing a Santa Claus rally in December. I'm seeing that, and I also feel that there will be a lot of activities in the market towards the last few weeks. That's the stock market in the last few weeks of the year. Portfolio managers normally like to take positions against final year results of companies, especially banks, in next year, full year results. So I see a lot of people taking positions. I'm also looking at tier one banks, that's the likes of tier one banks are what Americans call too big to fail, too big to save. The likes of First Bank, UBA, GT Bank, Zenith Bank, Access Bank. And for the non-tier one banks, I'm looking also at Fidelity Bank. I think, yeah. Then of course the cement companies, Dangote Cement, and also for the consumer goods, Dangote Sugar. Those are the ones I'm looking at. And of course, people also take positions in oil and gas, especially Seplat. Any company that derives its revenue from FX right now, you understand, is a stock that investors want to have a piece of, because they sell crude oil as Seplat, and the revenue is in USD. So those are the kind of companies that you see a lot of activities on towards the end of the year. Portfolio managers want to recalibrate their position against what they feel to be next year. I also feel that we also seek a continuation of capital raise by banks early next year. I'm also looking at non-banking companies too, especially consumer goods companies, also wanting to raise capital. We saw that with Nigerian breweries earlier on, I mean, a few weeks ago, some time ago. So many of them to have to, because many of these companies to have large FX losses. So they want to restructure their balance sheets. So I'm looking at them also raising money. In the case of Nigerian breweries, what happened was that they're saying the parent company will say, convert the loan into equity to take up my rights and things like that. So we'll see a lot of that. A lot of activities are going to be happening between now and January next year.
Right, and we've also seen some sell-offs in the markets. I think that started, Friday, then Monday, and today's decision day. So I'm wondering, how would the decision impact the stock market, or is it already priced in at this point? Do you think it might just be a negative week regardless for the all-share index?
To a large extent, it's already priced in. It's already priced in, and what happened earlier on was just profit taking. People coming out of stocks and profit taking. Most of the gains in the market happened earlier on during the year, and right now most people are just trying to reposition themselves for next year. So I don't see any. Yes, there'll be standard clause rally, but it's not going to be so major, but there'll be some particular stocks. But most of the gains we saw in the market now were early on during the year, especially in Q1 and Q2.
Right. Yeah. All right, let me come to Professor Nana. We got that breaking news earlier today that the Port Harcourt Refinery started processing crude oil, and definitely that came as a surprise to a lot of people, this morning. But it's quite exciting news. How are you seeing that?
Well, if this is true, then it's long overdue, because this is one of the few refineries that they have been trying to fund and, I guess, renovate for the past couple of years now, where it's been seen low productivity coming out of there. But I also read in the papers, I don't know how true this is, that the presidency is considering privatizing this, selling it off. And if this is true, this comes as a welcomed news, because in the end, history has shown this over and over again. Private companies perform or outperform government entities. That's why public-private partnerships most of the times work. But if you privatize an entity, it's always going to produce better results than if it remains 100% government. Two, and perhaps more importantly, now that this is online again, it tells us that we will have larger FX to actually help defend the local currency, which will enhance the purchasing power of the Naira over time. So this is a welcome news across the board, to be honest with you. I personally feel that when you dimension the Port Harcourt Refinery along with Dangote Refinery, my guess is both of them combined could be able to meet up with the demand internally and, of course, have some left over for export to generate more FX for the economy. So I think it's a welcome news if this can hold true. But quite frankly, history has proven that they have funded this, tried to bring it back online for years, and somehow it shuts down after a couple of months.
We'll definitely be looking out for that. And I think we have some visuals now of the governor. I think he's getting seated at this point. We'll put that up at some point. We'll see the room. The energy is coming alive there for the last rate setting meeting. That's for 2024. And definitely the governor is going to address us in a couple of minutes. And it's still the same issues before this MPC and this central bank. Definitely, it's all about taming inflation and bringing some kind of stability to the FX market. And definitely, hopefully, at some point, we'll get the strengthening of our local currency. But because most of the inflation we see right now is because of the weakness we see with currency and with prices, rising at an astronomical rate. But let me come to Mr. Ashiru now. So it's upon us at this point. And if we look at the data from for the trading yesterday for the FX market from FMDQ, we see there was weakness again. But we see that the Naira has been trading within a range so far. But it's mostly weakness we see. If you're looking at the official window, we know the parallel market, we see how, it's playing out there. We're already on that 1.7 level. So how are you seeing this MPC looking at, the Naira, at this point?
I think to a large extent, like the Professor mentioned earlier on, there's a lot of liquidity in the system. And the government pegging CBN pegging CR at 50% is just to sequester most of the money. But I don't think, even at that, I think there's still room for more, but I know that CR will not change. One of the reasons why the rates are so high, especially T-bills and co, is to continue to attract capital importation. So I think the major thing the government is going to do right now is just for now to end the year with increasing the NPR. I think that's what they'll do for now. And but the next year they'll look at the financial environment and then make another decision.
All right, I think the central bank governor is addressing us at this time. Let's cross over and listen.
To this press conference. The Monetary Policy Committee, MPC, of the Central Bank of Nigeria, CBN, held its 298th meeting on the 25th and 26th of November 2024 to review recent economic and financial developments, as well as assess the risks to the outlook. All 12 members of the committee were in attendance. Decisions of the MPC. The committee was unanimous in its decision to further tighten policy, and thus decided as follows. 1. Raise the NPR by 25 basis points to 27.50% from 27.25%. 2. Retain the asymmetric corridor around the NPR at plus 500 to minus 100 basis points. 3. Retain the cash reserve ratio of deposit money banks at 50% and merchant banks at 16%. 4. Retain the liquidity ratio at 30%. Considerations. The meeting was held on the backdrop of renewed inflationary pressures as the headline food and core measures rose year on year in October 2024. The committee was particularly concerned that all three measures also inched up on a month-on-month basis, suggesting the persistence of price pressures with attendant adverse impact on income and welfare of citizens. Members, therefore, agreed unanimously to remain focused in addressing price developments. While food prices remain a key contributor to the uptick, members commended the efforts of the federal government for the improved security, especially in the northeast of the country, which would likely improve food production. The committee also noted the role of rising energy production. The recent increase in the price of premium motor spirit, PMS, has also impacted the cost of production and distribution of food items and manufactured goods. The committee was optimistic that the full deregulation of the downstream subsector of the petroleum industry would eliminate scarcity and stabilize price levels in the short to medium term. Members thus reiterated the need to strongly forge ahead and fiscal authorities to ensure the achievement of our synchronized objectives of price stability and sustainable growth. The committee noted the improvement in the external sector, reflected by the increase in the current account surplus, enhanced remittance and capital inflows, which have impacted the external reserves positively. This, therefore, suggests that key policy measures by both the monetary and fiscal authorities are yielding the desired outcomes. Members, however, expressed concern over persisting exchange rate pressure, reflecting continued high demand in the market. Consequently, the committee urged the bank to explore measures to boost market liquidity. Members noted with satisfaction the continued resilience and stability of the banking system, despite significant exogenous and endogenous headwinds. Key financial soundness indicators, such as the capital adequacy ratio, CAR, non-performing loan ratio, NPL, liquidity ratio, LR, amongst others, remain strong. The MPC, however, called on the bank to maintain its close surveillance on the banking system to sustain compliance with regulatory threshold and continued health of the industry. The MPC acknowledged the efforts of the bank in deepening financial inclusion towards improving the transmission mechanism of monetary policy to enhance policy effectiveness. From the foregoing, members thus focused on the optimum policy choice to address the uptrend in price development, stabilize the exchange rate, and anchor inflation expectations appropriately. Key developments in the domestic and global economies. Data from the National Bureau of Statistics showed that headline inflation year on year rose to 33.88% in October 2024 from 32.70% in September 2024. On a month-on-month basis, it also rose to 2.64% in October 2024 from 2.52% in the previous month, with both the food and core components contributing to the continued rise in headline inflation. Food inflation rose further to 39.16% in October 2024 from 37.77% in September, while core inflation also rose to 28.37% in October 2024 from 27.43% in September. The MPC, however, noted the moderation in the prices of farm produce and commended the efforts of the federal government in driving increased productivity in the agricultural sector. The recovery of output growth was sustained, with real GDP year-on-year growing by 3.46% in the third quarter of 2024 compared with 3.19 and 2.54% in the preceding and corresponding periods respectively. The growth was driven by both the oil and non-oil sectors, with a notable contribution from the services sector. The non-oil sector grew by 3.37% in the third quarter compared with 2.80% in the second quarter, while the oil sector grew by 5.17% year-on-year compared with 10.15% in the preceding quarter. The external reserves rose marginally to 40.88 billion as of 21st November 2024 from 40.06 billion at end of October 2024, available to finance 17 months of imports. At the global level, the IMF projects growth at 3.2% for 2024 and 2025 from 3.3% in 2023. Risks to this outlook, however, include ongoing geopolitical tensions such as the lingering war between Russia and Ukraine, as well as the crisis in the Middle East. The deceleration in global inflation is expected to continue into 2025 and move towards the long-run objectives of key central banks in the advanced economies, albeit at a slow pace. This, however, faces a growing risk of reversal as talks of trade tariffs heighten following the outcome of the November 2024 United States elections. In view of the above developments and identified risks, members reiterated their commitment to price stability as the bedrock of a thriving Nigerian economy. The next meeting of the committee is scheduled to hold on the 25th and 26th of January 2025. Thank you.
Thank you very much, Mr. Governor, sir. That was communique number 155, presented by the chairman of the MPC and the governor of the Central Bank of Nigeria, Mr. Olayemi Kadusu. We'll now take questions from members of the press. state your name, your medium, and ask your question. Do not ask more than one question, please. Thank you.
A very good afternoon. Very good afternoon, everyone. Well, my question is, with inflation at, the name is Musa Abubakar. I'm with NTA. My question is, with inflation at 33.88% in October, up by 1.18%, what steps will the CBN take to meet its 21% target for 2024? Thank you.
Thank you very much, Musa. Let me first say that the central bank is resolute and committed to continuing to fight the war against inflation. There's no going back on that. And as I have said at previous fora, we are going to deploy everything in our arsenal to ensure that we are able to tame it. And of course, this entails the return to orthodox monetary policies. The return to orthodox monetary policies. So I think it is important to state that upfront. There's no going back on that. Now, it's also important for people to understand that there's a time lag between when you implement policies and when they have an impact. And that time lag, quite frankly, can be anything up from 6 months to 9 months to a year. It all depends on what you're doing. Our own perspective is that we expect to see greater results in the first quarter of 2025. And you can do the math from the time we started tightening. So we expect to see this in the first quarter of 2025. In addition to that, we are working very assiduously with some of the relevant agencies to ensure that those structural impediments are handled appropriately. See, some of these things themselves take time: supply disruption, infrastructure, a whole host of different things. And ours is to collaborate, to advise, and to help such that at least we begin to make that transition to a point where these issues are adequately dealt with. On our own also, we are doing what we can within the limits of our market, and in particular the foreign exchange market. And by that I refer to the fact that we appreciate that many times some distortionary elements come into a market, and that is why we as regulators, that's what we are there for. So we are ensuring that we're on top of the game, and that the foreign exchange market operates at its most optimal manner, and so it will reflect the true value of the currency, and of course you have price discovery. Then finally, something else I think is important to say, and that is that if you, and for many of you, many of the press, many of the members of the press who were at the World Bank IMF meetings recently, you see those fora also offer an opportunity to interact and to exchange views and rub minds with people who come from different parts of the world. And really and truly, if there's anything those people that attend should get out of that, it is that. Talk to people in other parts of the world, see how they themselves have dealt with some of the challenges that we are facing. And you'll find out that we are not alone. we are not at all alone, and that the road of travel is similar. These things take time. You've got to stay the course and you reap the benefits. And for those who, again, have made it their duty to monitor how different economies handle these kinds of problems, if you talk to them when you visit these kinds of events, you can see that the expectation is that Nigeria definitely is on the right path and will continue to be as far as inflation and foreign exchange management is concerned. So I think the bottom line of all this is that these are all time-bound issues, and we do expect that in the fullness of time we will begin to see the greater reaping of some of the benefits of the great tightening and the sacrifices that everybody in the country has made.
Thank you, Mr. Governor. My name is Mark Tibo from Leadership Newspapers. So there are reports already that the foreign reserve has risen, for instance, like you said, to $40.88 billion. That's a good achievement. And then the foreign remittances, over $600 million. But I want to know, what will be your reaction or your response to those who are concerned that despite this rise in foreign reserve and the foreign remittances, that the Naira's exchange against the foreign other currencies, especially the dollar and the pound sterling, is still very weak? What will be your response to them, sir?
Thank you very much. Yes. Okay, first and foremost, maybe I should unpack that question a little bit. Diaspora remittances, absolutely, they've gone up. And I would say that they didn't just go up on their own. They went up as a result of a deliberate policy on the half of the central bank, and I've said this in previous fora, to address all the bottlenecks that were in the way of diaspora remittances coming into the country. So that has happened and will continue to. Then, of course, the whole issue of reserves, that yes, indeed, the reserves have gone up. The reserves have gone up. And again, we should bear in mind that the process of getting us to where we are with reserves has been a long, tedious one. And if those of you who can recall, when this particular administration started, we had a lot of problem with reserves. We had relatively lower reserves, early 30s, and we had a huge backlog. And happily, all those things are behind us now. They are behind us. And I think that is a clear indication of the fact that the policies that have been used have begun to bear fruit. They have begun to bear fruit.
All right, there you have it. It's another hike. Some will say maybe it's a dovish hike at this point, but it's 25 basis points. Consensus was about 25 to 50, and 50 being the worst case scenario. So we have it there, 25 basis points hike to 27.50%. They retained the asymmetric corridor to plus 500 negative 100 basis points. They retained the CRR at 50%. So at the end of the day, it's another hike. I guess the surprise would have been a hold, definitely. And I still have with me in the studio here Mr. Dolakwa. She was Managing Director, Interstate Securities Limited. Professor Joseph had to step out, and definitely will continue the show right here with Mr. Ashiru. So yeah, it's your prediction. You said 25 basis points, yes, and it's here. It's another one. So 25.50%, getting more expensive to get credit, at this point. So talk to me about this latest decision and what you're expecting for the markets.
Yeah, the market has always been expecting, if it was a hold, we would have been shocked. We're expecting 25 basis points or 50 basis points, but I was looking more at 25 basis points, and that's what they said. I think they're just being cautious, I think that they had to do something before the year comes. They won't want the last meeting to be that we didn't do anything kind of meeting. Someone had to give, and they decided to be dovish, which was 25 basis points. So to wrap it up at 27.5% for the year, I think that's dovish. And the market is expecting this, and based on this also, it's obvious that even next year, for the whole of next year, we're going to see high inflation. We're going to see the fact that the MPR will also be in the 20s also next year. My own expectations is mainly for the GDP. I think that something has to give, because we can't continue a very, very lackluster kind of GDP. If we really want to move forward as a country, our GDP needs to move towards 6-7% at most, the size of our economy and our youthful population. And I think and one of the ways that we can do this policies, government needs to change a lot of policies. Yes, agriculture is really moving forward, but the major problem was insecurity. And I think to a large extent now, especially in the Northeast, things are getting calmer now overall. Although there's still some hiccups in the Northwest now. I think as the Northeast was cooling down, the Northwest started to show signs. But I think ultimately, that most of next year, the government will face more of easing things, terrorism activities in the North, so that agriculture can really start to blossom. And also look at our entire food value chain, and also policies that will also unleash potential in many sectors. For example, rail. We need to talk about rail. Rail, even, I'm happy that the Port Harcourt Refinery is on track now, but I also want to see the rise of modular refineries. I think that would be a game changer for the oil and gas sector. The rise of modular refineries, I think that will really start to boost our oil GDP. Then policies and a conducive environment to also help our non-oil the non-component of our GDP. What that's very there to me is what I call the unease of doing business in Nigeria. Come here to look at it. You understand? For example, I'm bringing goods in from the north to Lagos. I passed like maybe 100 checkpoints. What's that now? I'm trying to take things out of the country. I have to fill so many forms. They have to look at these policies that will make entrepreneurs have some form of relief, so they can start to blossom. I think that's what the government needs to look at it, because we have a lot of unease of doing business in Nigeria. Look at those policies because funds always go to where returns are highest, so that we can start putting funds into these places, and policies need to be very, very investor friendly, so that the economy can start to turn around.
Yeah, so they actually make this economy look more attractive, and definitely we will have to say much. When your economy looks attractive, you don't have to go out there to woo investors. I believe they will come and they will actually beg you, with their money at this time. But we see they also raise concern, the MPC, about exchange rate pressure. That is a huge headache for most companies right now. But with what you're seeing so far, do you think we might win this war, when it comes to strengthening the Naira, at some point in 2025?
One of the things that I liked about this government was that diaspora remittances are coming up, and they removed all the bottlenecks, all the bottlenecks. So there are more people are now remitting money directly down, unlike before. I think we have to look at the entire ecosystem and look for policies that will bring in a lot of. To me, I think that unlocking diaspora remittances is also a major way, and also non-oil exports. I think that's what we need to do. If we do that, I think things will start to turn around gradually, but it won't take, not something that can be achieved in 1 year. I think it will be achieved over maybe in a 2-3 year kind of horizon. I think if all the policies are in place at this point, I think things will start getting better. But next year is just recovery. I think things are going to get better, but they're going to get a bit bad before they get better. But
right, definitely. But we need to always move or find a way to move in the right direction. Even though it's going to be a long-term battle. But it was great having you to help us unpack this last decision rate-setting meeting. That's for 2024. We'll be back again in 2025. Thank you so much, Mr. Dolapo Ashiru, Managing Director, Interstate Securities Limited. Thank you so much.
Thanks for having me.
All right, there you have it. That's the decision for this final rate-setting meeting for 2024. I guess we'll be looking forward to 2025 for the next meeting. That's in January, and maybe we might see the macroeconomic headwinds get better we can see maybe some rate cuts at some point. But thank you so much for watching this one with us. I'm Ladi Williams from me and the team right here at Channels HQ. It's bye for now.